Yeah, let's start. So liquidity is an important resource to markets, and markets, whether already existing or markets we'd like to build. And actually, DeFi has set up very innovative and interesting solutions to bringing liquidity to markets. And if you think of it, ICOs, AMMs, down to balancers, LBPs, are new instruments to create exactly that. So who brings liquidity to markets? These are special market participants, liquidity providers, and what they say, essentially whatever the syntax is and whatever the vehicle is, they say, I'm willing to trade that many X's against that many Y's. And of course they do it for profit. And it's important because it's the aggregate amount of liquidity that's on offer from the liquidity providers that's going to build the depth of a market. And depth is roughly the ability of a market to absorb orders of substantial size. So the larger the depth, the more the price stays stable under large orders. And of course, if the price is stable, it means it's a good signal, so I can use it as a way to evaluate my wealth, and that brings me more confidence into when I enter and when I exit a market. So good, overall good. And what I want to talk about today is a new mechanism to bring even better liquidity to markets. And that mechanism we're going to call, for the duration of this presentation, a reactive market engine. And we've built one, obviously, which is called Mangrove. So this is what we're going to talk about. So more appealing, more efficient, easier to use, and eventually more profitable. So before we describe this in any detail, let me give you just an impression of what it is. So here I'm connecting via the dApp to the Mangrove exchange on a pair. This is the ETH DAI market, and I'm trying to buy 10 ETH with a bunch of DAIs. So there are two things that we have to, before I launch this really short 5 seconds clip, there are two things we need to look for. So one is that the order I'm going to shoot at the market is quite substantial. So if you look at the right side of the panel, you'll see that it's going to eat up a substantial amount of what liquidity is provided on that side of the book. So the red part of the book is the aggregate offer to sell ETH on that market, the asks, as they're called. And so that's the result of the action, which is me shooting a market order to the exchange. And now what's going to happen next, at the end of the 5 seconds, is that you'll see that this void that I created by shooting my market order is going to be filled instantaneously by a bunch of bits that are going to jump in the void. So I shoot, this is my action, and the market will react, so reaction, by jumping in the void that I create with my market order. So let's look at the clip. It's not very long. A few seconds. Success. Up. Have you seen it? I think I repeat it for another 5 seconds. So you see that the liquidity jumps to the right. And of course, the price increases a lot because there's a lot of slippage. So what's happening here behind the scene? What's happening is the offers that look like offers actually are code. So to each offer is attached a piece of code, and it's the action or the reaction of that piece of code that we just looked at in that video. So let's go into the sequence of things that happen. So the first event is I shoot a market order. This is received by Mangrove. Mangrove will split my market order into tiny little slices that each match an offer that's on the book, and then it will call the code that's attached to the offer. Now, that code is in charge, and it turns out that right now, with that example, there's just one big piece of code that has all the offers on the red part of the book under management, and it's called Mango. That's a smart contract. And what the smart contract will do is, well, it will deliver the liquidity from some source of liquidity, more about that later, but it will also take control of the book a second time and replenish the set of offers it's actually placing on the book. So that's the reaction part of the piece of code that manages the offers. And like I said, that code can be any piece of code. So in particular, in that case, Mongo in the implementation is actually sourcing the liquidity from Aave in that particular case, which means actually there is nowhere, at no time, any liquidity which is captured by the book itself. It's just always somewhere in a remote source that the code can access. All right. So this action is the red part of the video, and this is the green part of the video, the reaction. So let's now open up Mongo and look at how it reacts, what's the code behind. So it applies a very simple strategy, which is to lay down a price grid with a bunch of price points. Actually, I think here we're using something like 1 point every $10 of ETH. And when an ask is matched, then what Mongo will do, it will take in the cash, deposit it to Aave, and rebuild on the bid side a new offer to buy back what it just sold, just 1 price point lower. So sell high, buy low. It's one of the basic market making strategy. And of course, conversely, it does the opposite when it sells. It tries to buy back. It tries to buy back 1 price point lower. There are many variants, but this is the simplest. And just to give you an idea, this is 900 line of code in Solidity, so it's about the same order of complexity as Uniswap v2, and it's completely on-chain. So in that respect, it's an AMM. Mongo is an AMM. Mangrove is not an AMM, right? So how does it perform? Well, we backtested it against Uniswap v3, so Mongo is in green, Uniswap v3 is in red, so we consistently beat the performance. The backtesting period is from beginning of May 2021 to end of March. And the other thing to notice about that diagram is that the ranges of the two strategies, for the sake of comparison, are the same, 1,500 to 5,000. So the mean price of operation and the max price of operation. And the other thing to notice is that Mongo here, the way it was configured in the simulation, was using only 10 price points, so a much sparser price grid, quoting every $300 worth of ETH. It's interesting. Super simple market making strategy. So here I need to prevent a bunch of misconceptions. So when we say bring your own logic, it really means bring or build or borrow your logic. Mangrove is not specific about which kind of logic you should use to manage your intentions to trade. So Mongo is one particular way to do it, and this is an example that we've built and with which we actually make our markets on the testnet, like you've seen. But it's not a stipulation that you should use the same. So please build your own. So Mangrove is the platform, the market engine. Mongo is just one strategy that runs above it, and you can clone it, tweak it, and run your own copy on the side of it. If you make a copy and you tweak it and you deploy it, it will run on the same joint platform. So in a way, you can think of Mangrove as aggregating the joint behavior of many little automated market-making strategies. So this is very different from Balancer's custom pools, for instance. They let you specify your own maths, but as soon as you create one, it's alone in the world, and it has to bring its own liquidity. If you create another one with another piece of maths, it's going to be fragmented. It's going to be next to it, not together. Also, similarly, the way Mongo sources its liquidity by Aave is just one example. You could use Morpho, you could use Compound, you could even use LP tokens to another AMM, whatever fits the way you're managing your liquidity, as long as you know where to find the code to connect, or even better, if you know how to write it yourself, then it's eligible. So it's super flexible. All right, so talking about flexibility, let's examine maybe a bit more sophisticated ways to provide liquidity. So here I describe a family of liquidity providing strategies that have roughly ballpark the same mathematical guarantees as Mongo, but allow you to express more of what you think is going to be the price action within the duration of interest. So they're all based on the concept of cash ratio. What's a cash ratio? It's a function that's defined between a mean price and a max price of your choice. And for every price in the middle of that range, it will specify how much of your portfolio in value you want to hold as a percentage, for instance, you want to hold in cash. So if you say 50-50 over the entire interval, you have a kind of a Uniswap V2 type of a way to manage your cash ratio, but there are other ways to do it. For example, the blue line is maybe the most natural. It's a linear interpolation. So, and by the way, all the three curves that I'm presenting here define cash ratios, and they all share the same common behavior, which is that you hold actually zero cash at the bottom of the interval. So you're holding the low asset, and you hold none of the asset at the top of the range. So you're selling on the rise, and you're buying back on the low, which is typically what the market making strategy does. So the banana-shaped green one, just in case you wonder, is actually Uniswap v3, which can be captured very neatly in this type of syntax. And the sigmoidal one, so what exactly do you express with that sigmoidal cash ratio function? Well, you express the belief this is going to trade harder near the middle price, right? So the rebalancing will swing harder when it's at the place where the sigmoidal has a high differential. So what you're expressing, if you pick up that particular way to provide liquidity, is that you think that the price action will mostly happen in this middle price. So it's good to have diversity in the way you set up you express your liquidity providing strategy, and this is an example of how to give it simply. I should say importantly, and I haven't said it yet, that they all satisfy the no permanent loss property. So you can prove mathematically that if the price loops on itself, you're not losing, and actually you're winning. And if you use a discrete form of those strategies, which we do on Mangrove, you actually increase geometrically your returns each time the price loops on itself. So the worst that can, if things go wrong, then the price can escape at the top of the interval or at the bottom of the interval, and then you don't make any profit anymore. But that's impermanent loss, as people say. So this has nothing to do with Uniswap in particular. It's a very generic mechanism. And last word about that, on the pure mathematical standpoint, there is absolutely no reason to pick up the maths of Uniswap v3 against another one. They all have the same properties. So you can extend that logic. This is a rather extensive but still very simple class. You can inject new signals, variance, volatility. You can make it time dependent. You can make it depend on momentum measurement devices. You can use signals that are available on chain. And of course, you can generalize that to multiple assets. That's all in our drawers. So you can have index-based strategies of the same type. So that's about what I want to say for the flexibility of the way you provide liquidity. Now let's say just a word about the way you manage the liquidity. So the fact that the liquidity is not in the book, but somewhere else. So here we work out a little model, which we call fractional reserves. So the game you want to play, you want to trade off between the cost of moving your liquidity back to where it's needed just in time, and the returns that you're making if your liquidity is in your savings account, if you wish. So you pick up two parameters, one R, which is the interest rate which is served by whichever source you're using. So maybe it's the supply rate on Morpho, for example. And C for the cost of transfer. And for the sake of the argument here, I suppose transfer is has a symmetric cost, whether I deposit or withdraw. So clearly, if the rate is dominating and the cost is very small compared to the rate, then you should always push everything to your savings account, right? Because what you get there by far exceeds the cost of moving things back and forth. So that's one extreme regime. Another one is when the returns are very small and the cost is huge, and in that case, you should not even consider managing your liquidity in a remote place. So, but what we've seen by backtesting on actual data on 3 different markets, the main liquid markets on Ethereum, is that with very simple stochastic control based on when you have an excess of liquidity on the local money side, then deposit it to your lender, and when you're below a certain amount of liquidity locally, then withdraw and replenish to a certain fraction of your reserves, then with this very simple-minded control, we actually managed to get exceedingly good performance, contrary to what one might think. So the way we measure this, we draw a line at 100. This is the maximal amount of returns that you can expect to get. This is the one you would get if the cost of transfer was 0. So then you would put everything remotely all the time and, and get 100% of the ideal profit. And what we see is when the fraction R divided by C, so how this increases with how easy it is to make money remotely, or how non-expensive it is to move things around. And we see that on one of these markets, you get 80%, even in very degraded condition of this ratio. So that's good news. All right, so let's summarize into my two last slides the benefits of working with a reactive market engine if you're a liquidity provider. So first of all, you can bring your own logic. We have a very flexible class of super simple strats, just like Mongo, but expressing your desire to balance your portfolio as a liquidity provider in a more flexible way. And of course, you could run this manually from off-chain, but it would be a nightmare of infrastructure, robustness, asynchrony. You can also bring your own liquidity source. So this means that the DEX, the platform Mangrove, doesn't lock your liquidity, and you're at complete liberty of using it in the way you want. Of course, again, you could try to shoot from off-chain tiny updates and transfer orders, but that would be, again, very cumbersome and very actually demanding in terms of infrastructures. So one clear, simple benefit is that to run your liquidity provision strategies in this fashion, you don't need any infrastructure off-chain. Actually, the only infrastructure that you use is the blockchain itself, which is particularly elegant. So you can set it and forget it. And long after you died, as the title suggests, it will keep self-financing, moving around money, and make profit every time the price loops. And the fact that you have no asynchrony, and I conclude with the next slide about that, is a bit so no asynchrony means that when your code runs, it actually runs on-chain, so it knows everything about the context in which it's evaluating its own options. If you're off-chain, you may be able to deploy a lot more intelligence, computationally be much stronger, but then you have to shoot your order, it will be in flight, and while your order to the market is in flight, things will move. So the evidence on which you base your decision may no longer be the case by the time it's executed. And this is a reducible asynchrony. Except that, so here in this model, you always execute last. When the market engine calls you, you're fully synchronous, you can do crazy things. So what crazy things can you do? So let's dream a little bit. This is the last slide, as I said. Further than what we've already demonstrated, and these are just ideas, they've not been implemented yet. One thing you can do is you can define your price. So the market engine passes you a match, and you can actually pass on that match. You can say, well, I'm no longer interested. I'm measuring X, Y, Z on chain, and I see that maybe I was underselling. So at a certain cost, which is a bounty that you have to pay to the engine and the taker, you'll say, okay, no, I just want to update my positions. So I'll take the reaction part, but thank you, I'm not going to deliver what I promised to deliver. The opposite can happen, of course. During the flight, maybe you're overselling, so the taker was actually misguided in taking your offer, but there was no way you could tell. So there can be positive slippage, and you can pick this kind of foamy arbitrage opportunities on the fly. So this is the advantage of being on-chain, right? Another interesting thing you can do is you can self-leverage. So the engine has a peculiarity that I didn't mention yet, which is that when it triggers the execution of the code that manages a given offer that is currently matching, the engine actually will give the money of the taker to the code. So now the code has the cash of the taker. One thing you can do, which is very natural to do, is to deposit it. That will increase its borrow capacity, and on the back of that borrow capacity, it can actually borrow what it promised to the taker. So not quite everything, but 3/4 of what was promised, which means that you do a ×4 leverage on the amount of capital you actually have to have control of compared to the one you're publishing. So this is like margin trading, but there is no margin trader. There is no mechanism. You're just leaning on the lending, the liquidation infrastructure of the lender. So you don't have to ask permission. There's another type of leverage, which is even more Mangrovian, which is that you can actually publish the liquidity that you have access to on 2 different markets at the same time. So let's say you have a bunch of A's, 10, let's say. You can sell them on the AB market and on the AC market at the same time. Now, whichever of these 2 offers will be hit the first is going to trigger the same code. And what the code will do is, if your 10 A's have been wiped out by consumed by the taker, then what it does, it will erase the other competing offer on the other book. And then, now let's say it has 10 B's. So again, the code can republish those 10 B's on both markets, AB and BC. So each time, and same thing, if you're taken on C, then you republish on both markets. So what you're doing here is a completely one-of-a-kind type of leverage, which is leverage using the temporal structure of the the execution environment. So you do ×2, ×3, times n-1, or n is the number of markets on which you play simultaneously. And because the execution environment of the EVM is sequential, there is no mathematical risk that you'll have an overfill or that you'll be found insolvent because you promised too much, much more than you could actually fulfill. So if you think of it in terms of CPU time, you actually have a semaphore. You're the only one executing, and you have you can manipulate everything which is within the access of the execution environment. All right, so that concludes this presentation, and I'm happy to take questions if you have some.
Thank you, Vincent. Questions out there? Here we go.
So with regards to liquidity, since you don't have locked value, how do you there are some conditions where the market can be very volatile and where a lot of your actually orders could be ghost liquidity like you just described, and so how do you handle that case where it's just a lot of orders actually don't have the liquidity anymore because it was just used a few milliseconds ago?
So the engine is fail-proof. So if your offer doesn't work for whatever reason, maybe because you don't want it to work, or your code doesn't want it to work, or maybe because there's an accident, maybe the lender you're drawing liquidity from is insolvent, it happens, maybe the pool is dry, then the market engine will just continue, switch on to the next offer and carry on the execution of the market order. So there is no discontinuity of service, so to speak, if there is a failure. That's the first thing. The second thing is, obviously, we like the book to hold credible offers, right? So we want it to be plagued with just failing offers. So what we do is very simple. We make it free lunch for specific actors to actually shoot offers that fail. So now a liquidity provider has to give on top of the intentions to trade and the code to call a bounty, which will be given to the taker in the case the offer fails. And so that's essentially a free lunch to keepers, people who know how to connect to use the entry point, the program entry point to shoot an offer. And so we've written keepers ourselves, but we expect people to actually take the free lunch.
Thank you.
Great. Other questions out there? Great. Another question?
But we're not fully relying on keepers either for asynchrony problems. So if they fail, then the market engine just continues fine.
Since this is a pretty unique system, which kind of LPs do you expect to be using your protocol? Do you think there is going to be one-day integrations which allow retail actors to be LP and Mangrove?
So we're still in the process of discovering, potential customers and market fits and things like this. So it's a bit too early days for me to give you a definite answer. But we've certainly looked into what you're suggesting. Put one of those strategies that's really easy to program into a little box, connected to a good source of lending, let's say Morpho, and we do a little Morpho box, and then we'll knock at the door of large liquidity providers on Aave, for example, on Morpho, and we'll tell them, why don't you also liquidity provide to that market? You don't have to touch your liquidity. It's just going to happen by code. Maybe you don't want to disrupt the structure of your portfolio too much, but maybe a little sliver of what you have in the fridge will be animating our market. So that's one road of inquiry. But there are many more. For example, token issuance is a super application. With a reactive market engine, you can go way further than the LBPs of Balancer. So liquidity bootstrapping tools are actually quite used by DeFi projects for obvious reasons, because you have to bring less capital to the table when you want to do a public sale of your token. But with an engine like this, we can actually bring the amount of cash that you have to add to zero, which seems just very intuitive. We can guarantee to the token issued that the project cannot lose money. It can fail to sell its tokens, obviously, but it cannot lose money. It can only win if there is some price action. And from the point of view of the investor, we can also guarantee that the underpinning logic will rebuy everything at a floor price, for example. So that's another avenue to markets that we're exploring. And then we also would like to use this kind of market engine for semi-fungible tokens, for example. So there are many assumptions on the table. In 3 months, we'll probably have done our homework. We'll know a lot more about what are the good ones we want to focus on.
Great, thank you. Do we have any other questions? Otherwise, you're, of course, welcome to meet with Vincent after. And let's thank him again. Thank you.